In each annual letter that Buffett writes, and these are posted on Berkshire Hathaway's website, I think they might go back like 20 years at this point. He does outline sort of high-level acquisition criteria. I don't have them exactly handy, but it's something like strong brand name, good management, leading position, those types of qualities that he's looking for. And I think when you look at least the publicly traded stocks that he holds, you'll see a lot of those characteristics in many of those companies. But one of the core, and let's kind of get a little bit into our strategy now, the way at least that we've captured it, is based on the book Buffettology, which was written by Mary Buffett. It was written by Mary Buffett and David Clark. But one of the core concepts in that investment strategy is looking for stocks that have a competitive moat or competitive advantage around the business. And we try to flush that out quantitatively, looking at a few different things. So do you want to try to talk about how we capture that in the model?
Yeah, sure. This brings up the whole issue of can you quantify a moat? And I think, there's been a bunch of academic research done on this and with mixed results. It's very hard. Obviously, you can maybe potentially identify a firm that has a moat right now, but identifying whether that moat is sustainable is really difficult. And, the Buffett strategy takes an interesting approach to that. And one of the signs of a moat is high return on capital. And so this strategy looks for consistently high return on capital over a 10-year period. Basically, the three moat-like criteria are high return on capital over a 10-year period, high return on equity over a 10-year period, and consistent earnings growth over a 10-year period. So if you're able to sustain all of those things over a 10-year period, there's at least a reasonable chance that there's some sort of moat around your business that's preventing other people from taking that from you. So, it's just like any moat type criteria. It's not perfect. Obviously, some of these companies, the moat will not be sustained. But I think it's an interesting way to look, by looking at it over a really long time, it's an interesting way to look and say, is there a competitive moat there?
And in our model, we do allow for one dip in earnings to happen in that 10-year period, as long as the earnings come back to an all-time high. And then I think with the ROE and return on capital criteria, on average, U.S.-based companies have over the long term something like a 13% return on equity, return on capital. So if it's consistently higher than that over time, that indicates, at least according to the model, that there's some, like you said, competitive moat around the business. The one thing that you have to understand with capitalism and business is if an industry or company has higher than average profitability, what that results in is more competition coming in just naturally as competitors try to eat away at those profits. So maintaining that higher than average return on equity, return on capital over time is extremely difficult for many companies. And this model isn't perfect. It's what companies are going to maintain this higher than average return on equity, return on capital. It's just one way that you can start to try to get at, do these companies have competitive moats around their businesses?
Yeah, and getting back to your point about EPS dips, one of the things we've tried to do with these models is we tried to look at it as a person and say, if I was analyzing these stocks as a human being, what would I do? And then we've tried to quantify that. And that's what that criteria is. So for example, if you look at what we're going through right now, how many firms are not going to have at least some sort of dip because of the coronavirus in their earnings? Most firms will have, the Zooms of the world obviously won't, but most firms will have some sort of dip. And so as a person, you would say, all right, we had the coronavirus. I can forgive one dip in 10 years earnings because of this, as long as the trend continued. So that's what we're trying to do here, is to look at it the way a person would and say, all right, we can understand something probably is going to happen over the course of 10 years where you're going to have one problem, and we'll allow that as long as the growth continued after that.
And by the way, before we get into sort of the secondary criteria here, the other thing that Buffett often talks about is he likes simple businesses. He doesn't want things that are too complex, that he doesn't understand. I mean, he had stayed away from technology for the most part up until a couple of years ago when he started establishing a pretty big position in Apple, which is now his largest position. One of the other reasons that technology, I think, scared him, and I think this probably goes back to the teachings of Benjamin Graham, which was his professor at Columbia, was at least early on in the technology industry, earnings were highly variable. So if you think back to the late 90s, early 2000s, you had, many of them had no earnings, but, a lot of these companies had earnings that were all over the place. They weren't making money. So, being profitable and having an earning stream that Buffett can be confident in the future, I think is a very important part of how he invests. And it's an important part of how we've tried to construct this model as well.
Yeah, he's looking for businesses that are predictable, and you're probably right that back at the beginning of sort of the technology boom, the businesses were a lot less predictable than they are now, and now Apple's business is fairly predictable. Apple's a very established company, and so he adjusted his models, which makes sense to buy these types of companies because now they meet the criteria he's looking for.
In terms of the secondary criteria, and I think a lot of these are kind of very important to the environment that we're in. But the first thing is, Buffett doesn't want to see a lot of debt. I mean, if you read his shareholder letters, you'll find that, first of all, Berkshire Hathaway has no debt. But, the companies that he's investing in, he doesn't want to see a lot of debt either. I think there's something like, he kind of talks about this with derivatives, but I think it's also debt. When the tide goes out, you get to see sort of who's swimming naked. So in, a period like this, when it's really tough and companies that have a lot of debt, when the business takes a hit, and those debt payments stay there, it basically makes the company more fragile and potentially, not a good investment. So the debt criteria is it wants to see a reasonable amount of debt given the earnings power of the company.
Yeah, that's right. And all of these criteria sort of are like secondary quality criteria. So at first we've established we think there's a moat that can be predicted. And then secondly, we're establishing some other criteria that says, is this a high quality company? So like you said, manageable amount of debt. Is there positive free cash flow? And what he's getting at with free cash flow is, is CapEx not too high? If CapEx is too high, you're not going to have positive free cash flow. Sustaining, those assets is going to be expensive. You don't want to see that. You want to see retained earnings being turned into earnings per share over time. So he looks at sort of the percentage of total retained earnings that is eventually becomes earnings per share in the future. And then he also wants to see companies that are buying back their stock, that are doing things that are shareholder friendly. So I kind of group those into like the secondary quality criteria. We have the primary quality criteria, and then we add those on to see if there's some sort of other, and make sure there aren't any other negative issues going on with quality in the business.
Yeah, that's a good point. And so what the model does is it looks at each of those specific criteria and it says, okay, can debt be paid off, for example, in let's say between 3 and 5 years based on the earnings that the company is generating? Or, is like you said, is there positive free cash flow being generated by the firm? So those are all individual criteria that are incorporated in the model, and stocks are scored through each of those criteria. Okay, so then the last way, or the thing that's important, it's not necessarily a value criteria as much as it is, can you expect to get a above average future return on the stock when you buy it at the current levels, given the earnings power of the firm? And it uses two methods, the EPS method and the ROE method. We're not going to go into that in detail on this podcast just because it would be too much. But, if you just at a high level want to talk about how the model uses those two methods and really what it's trying to get at.
Yeah, so as we said before, this is primarily a quality model with a secondary, exposure to value. And in the case of value, what he's trying to do, it's sort of a more indirect method than saying, all right, the PE has to be below this. What he's trying to do is project future earnings using two different methods. One is to say, all right, if this firm can maintain the same ROE it has right now, what would earnings be, say, 10 years from now? The second one is if it can maintain the same earnings EPS growth it has historically, what would earnings be 10 years from now? And so I can take both of those future EPS numbers, and then I can apply a conservative PE ratio to both of them, and I can get a future stock price. And then by taking that future stock price and discounting it back to the present, I can figure out what is the implied return on the stock over that 10-year period. And so that's what it's doing. It's sort of an indirect way to get at value. And the strategy is looking for at least a 15% annualized return projected using those two methods, between the average of the two methods, over 10 years using that approach.